Welcome to Accountable, where your business is our business. Hosted by David R. Peters. Today's guest is Frances Ellington.
Hi, everyone. Welcome to Accountable, the podcast for CFOs by a CFO. Hey, my name's Dave. Thank you so much for joining us this week. One of the things that happened during lockdown is that a lot of companies were forced to have workers, maybe for the first time, working remotely. We had a lot of people working from home because we couldn't go to the office. I think that a lot of us assumed that when that first happened, that eventually we would go back to working in the office again. Once the restrictions were lifted, I think a good bit of us just thought to ourselves, you know what, this is just temporary, and once this is over with, everybody's going to go back to working in the office again. However, I think at this point, a lot of companies and a lot of employees have realized that that isn't necessarily what companies did. I think during lockdown that companies discovered that there's a lot of advantages to having employees working remotely. Employees generally like having the freedom to work wherever they want. Also, it makes for a potentially bigger hiring pool. When we're looking for employees, if we have a remote work environment, literally, geography doesn't really matter too much anymore. However, when you have employees that are working in a lot of different places, I think it is natural if you're a tax practitioner or if you have a background in tax to think to yourself, you know what, there's tax implications to this. When we have people that are working in multiple states, it creates nexus issues, whether that be nexus issues from a payroll tax perspective, possibly also from a sales tax perspective, personal property tax perspective, and even an income tax perspective. So from a tax standpoint, multiple states and having employees in multiple states makes a difference. And we're going to be talking about some of these ideas of nexus and how these ideas have evolved in more recent times with my guest this week. My guest this week is Frances Ellington. Frances is a tax partner at GHJ in the Los Angeles area, and she is an expert in multi-state taxation. This is something that she does all the time for clients, and she talks to them about these issues having to do with what happens when we have employees working in multiple states. And this is something that is a moving target, which she is going to mention throughout the interview, throughout our conversation. She's going to talk about how this issue of nexus has really changed and how it continues to change in light of everything that we have all gone through with COVID. We will also touch on how the definition of nexus has evolved when we think about what has happened in light of Wayfair in the sales tax world, and how perspective and kind of what we're talking about makes a difference in terms of that definition of nexus too. The fact is that income tax nexus is not the same thing as sales tax nexus, and we're going to touch on that idea in our time together today as well. So Frances is again, she's a tax partner at GHJ. She also does some adjunct accounting faculty work, and so she teaches for college students, and she just does a lot for our profession. And so I think that she is a great guest and certainly a great person to talk about this topic with. So enjoy my conversation with Frances Ellington. My guest this week on Accountable, Frances Ellington. Frances, thanks for being on Accountable.
Thanks for having me.
So first of all, we should probably start off, we don't want to bury the lead here. So you just recently made partner at GHJ, and so congratulations on your new role. That's fantastic.
Thank you. Very excited. A lot of fun things going on in the state and local tax world.
Yeah, no doubt about it. So, I mean, this is really kind of the one of the key things I think for a lot of small businesses, a lot of CFOs, a lot of controllers. Lockdown. We were forced to work remotely. I mean, a lot of companies, they didn't really have any other choice. They had to go to remote work. However, I think it's really interesting here more recently, a lot of businesses are deciding to stay remote or do some sort of hybrid model of, sometimes coming in a few days out of the week or, things like that. What sort of tax issues come up? Because I think that that's maybe the thing that a lot of at least small businesses are forgetting is that is that there's tax issues with people working remotely.
Yes, of course. It's a big issue, and I can explain a little bit more in detail. But I think the most important thing is that companies really know where their employees are. Because, for example, if they're working remotely and it's close by their current office or where the company is located, then typically not much will change. But if you have employees that are maybe traveling to different states or different locations and you're not quite sure where they're working from throughout the year, that can create a problem. The number one issue is really payroll tax. So,
Right.
payroll tax withholding based on the jurisdiction where your employees are physically working. And that will be an ongoing issue from year to year, regardless of COVID. For other state taxes, it was interesting because from an income tax perspective, a lot of state jurisdictions allowed for exemptions or maybe a little leniency related to tax filing requirements due to remote employees. Some of that is now starting to go away, but we see things like franchise tax or sales taxes that you could have issues with remote employees in those jurisdictions, as well as some other local taxes. And I don't have to go into the detail, but it's an evolving issue, and it can trigger more than anticipated just by allowing your employees to work remotely.
I think that that's a great point, and I think you brought up a couple of interesting things there. One of the things that we have seen in the income tax world is we have seen some states that have said, okay, just by virtue of the fact that you might have an employee that is in lockdown and their home happens to be in our state, we don't necessarily call that nexus for income tax purposes. I spent a fair amount of time in the Charlotte area. Charlotte's only a few miles from the South Carolina state line. So, a lot of people, they were working from home in South Carolina. And so that was, an example of where that might become relevant. But I think also to your point, though, because you brought up another, I think, important issue here. Just because something doesn't create nexus for income tax purposes, that doesn't mean that that's the same deal for something like payroll.
Yes, exactly. Payroll is probably the number one liability that companies have or exposure item for tax purposes due to these remote employees or accidentally triggered nexus, if you will.
So I think that that's a great point. And one of the things I guess I'm kind of curious about is, I think a lot of tax practitioners who might be happening to listen to this podcast, I think that they would look at that and they would say, okay, well, yeah, of course that's true. But I mean, the average client out there, I mean, do you think that they are even really thinking about this? Or is this one of those things that, like, we as tax practitioners that we're going to have to bring up?
Yes, I mean the average, client, depending on their size, depending on if they actually have tax personnel or if it's, an overall business owner that maybe knows enough about tax or accounting to be dangerous, but doesn't know the nuances of state and local tax. They may know that they, heard a little bit about some type of issues related to remote employees, but they really rely on tax professionals to educate them on at what point does it matter, right? So is there a number of days? Is there a dollar threshold for payroll, for example, or for activity in a jurisdiction? At what point do they need to review these types of items? At what point does it really impact their tax liability? Or should they make certain hiring decisions? Because we've had a lot of clients that have, started to approach us as they start to hire more and more remote employees. So this is, new hires compared to existing employees that are just working remotely. And those new hires that are starting to work remotely, you could trigger a new tax in a new jurisdiction because of those employees. So we have had clients that were trying to be proactive and educate them before they even make the hiring decision as to what new taxes will be triggered, what they should think about, if it is worth the cost benefit of hiring in that jurisdiction going forward.
Because that also brings up stuff with unemployment taxes as well, too. I mean, where you're actually paying for unemployment insurance, depending on kind of where that person is located. So it's almost kind of there's a lot of things to consider. I mean, from a hiring standpoint, and hiring has been a big issue for a lot of companies. A lot of companies are having trouble finding help. We've heard about, supply chain shortages and things like that, and the Great Resignation. That's what we're calling this thing, where everybody is changing jobs, and on some level in a remote world, it opens up opportunities because geography matters less. But at the same time, though, from a tax perspective, geography still matters. And I think that is where, especially if you're a tax practitioner listening to this, I think it's good to at least bring that up with your clients. I mean, is that a fair thing to say?
Yeah, absolutely. And, it's funny because it definitely keeps me employed as a state and local tax professional, but the rules are ever changing. And I think in my home state, which is California, one of the most regulated states in the country, it's very easy to, creep into local business taxes, to trigger sales tax, to now have a payroll tax obligation because you have an employee working in the state. So it's just really important that even if you're not ready to make those decisions right now, that you at least understand what the concepts are so that you can plan ahead and manage your business properly.
I think that's very sound advice. Let's talk about a term that comes up all the time when it comes to state and local taxation, is this term nexus. I mean, I think we've already said that once or twice here in our conversation. Can you talk a little bit about the idea of nexus? What exactly does that term mean, and where does it come into play, and maybe just how does it differ depending on the context that we're talking about? What is this thing called nexus?
Yeah. So great questions, and we get that a lot. I think we say the word just assuming a lot of people or clients or others understand, but really, sometimes we need to explain because it depends on the context, what nexus means. So what I mean by that is that nexus in general is the right of a state or local jurisdiction to assess tax on a business or even an individual. For tax purposes, it means different things depending on the type of tax that you're talking about. So for income tax purposes, typically physical presence will trigger nexus, and that could be people, property, certain level of activity or visits to the state, significant sales, even in certain instances, may trigger income tax requirement. There are specific exemptions. For example, PL 86-272, which is a federal law, which only applies to companies that sell tangible property. And I'm not going to get into the details there, but there are specific exemptions like that for income tax purposes. That specific exemption won't apply for something like sales tax. So for sales and use tax, and you may have heard of the Wayfair case or other noise and excitement about sales tax the past few years. And that is because the nexus threshold for sales tax has been significantly lowered in states over the past few years. And a general threshold is that, obviously physical presence will trigger sales tax nexus too. But you can also trigger sales tax nexus with a dollar threshold of sales. For example, $100,000 of items sold to customers delivered in a jurisdiction, or a certain number of transactions. And that could be as low as 200 transactions during an annual period or during the current year. So again, those numbers, if you're talking about a product that doesn't cost much money, selling 200 of them within a state like, for example, North Carolina, like,
Right.
what does that mean? Do you now have to register and collect sales tax for every purchase or item sold in North Carolina? So it's important to understand, but sales tax is tricky because a lot of states have different thresholds. So it's not the same, and it's going to vary across many jurisdictions. The other item that we kind of want to think about for Nexus too sometimes is property tax. So personal property tax, not all jurisdictions have personal property tax, but that would be imposed on business assets, for example, like office equipment, other types of personal property. Typically, inventory isn't taxed, but it might be reported. And those are measured at a certain point in time, for example, January 1st of every year. But again, you would have to have physical property in those jurisdictions, and you may still be exempt if you're below a certain threshold. So again, things to think about in terms of whether or not you have nexus.
Yeah, I think all of those examples I think you brought up are important, and I think it's great that you also touch base on the personal property one, because that is one that I think that sometimes does get kind of it's just not maybe on our radar screen. And I guess maybe that's the best way to put it. Even in certain states too, for example, I know Florida has a personal property tax, and so a lot of times I think people say, "Oh, Florida, no taxes," and not so much. I mean, so the state collects revenue somehow, so I do think it's important that we bring those ones up, and especially with clients, I think just awareness is probably a lot of the battle. I mean, is that fair to say?
Yeah, absolutely. And I would recommend just starting with your home state or your headquarters state,
Yeah.
and really just understanding the rules there. And then as you expand, you can start to really get a feel for whether, other jurisdictions matter, but understanding your home state is definitely the most important.
I think that's great advice. So let's talk about two terms that have become kind of I don't know, more popular, I guess is that the right terminology? But this idea of economic nexus and also marketplace nexus. So these are newer terms, not brand new, but newer. And the economic nexus idea really started to really come into kind of mainstream attention, at least in the tax world, after the Wayfair case. Can you just talk about what those two terms mean, and why should we care about this?
Yeah, of course. So economic nexus, again, as you mentioned, primarily a sales tax issue, but we do have a handful of states for income franchise tax purposes that will assess tax purely on a sales threshold. And that's what economic nexus really is. It's the ability for a state to assess tax without any physical presence in the state. So when we talk about economic nexus, we're usually looking at just sales shipped into a state without any employees, for example, there, or kind of other criteria that states establish that don't require any physical presence. And I think especially for sales tax, because the majority of states have enacted economic nexus that have a sales tax, it's a little bit scary for e-commerce businesses, because it used to be they didn't have much of a concern about jurisdictions outside of really where they did business and where their home state is. And now, very quickly, they have an obligation in the majority of states, or, all states where they have sales. So it immediately, triggers other conversations, including, does it make sense to still sell into those jurisdictions? Does it make sense to restructure their business? Does it make sense to now automate some type of sales tax software so they can meet these requirements? So there's a lot to unpack if you have a company that is now triggered economic nexus. But it is very important that those clients understand. And I will tell you that I do a lot of M&A work and looking at diligence and transaction advisory. And this type of economic nexus for sales tax is a very common issue. So it is something that you need to be on top of, you need to be aware of, especially if you're looking at planning, whether you're getting additional funding or capital, or whether you're looking at selling your business down the road. Understanding these types of things is very important.
I think all good points there, and let's talk about just to kind of sum up for folks, because I don't know how especially if you're working in industry, if you've heard about this idea as much, but the economic nexus idea for a very long time, up until 2018, was really all about where are you physically located. If you were not physically located in a state, the state could generally not assess a sales tax against you. And that was the rule for a very long time. Then Wayfair comes along, this Wayfair case, and the Supreme Court changes that. And it's rare for the Supreme Court to hear a tax case. So that's kind of one, sort of oddity there. But the other thing is that basically the Supreme Court basically came out and said what I think a lot of states were already thinking is that physical location of where a company is just matters a whole lot less in our modern world, because we have internet sales and we are just doing a lot more over state lines. Whereas, when this concept of physical presence really came about, I mean, it was way back, in the 50s and 60s. And, moving over state lines back then was a big deal. These days, I mean, it just matters a lot less.
Yeah, and I will kind of circle back to the second half of your question that was about marketplace nexus, right?
Yeah.
Economic nexus, again, it would be company specific. Marketplace nexus actually is interesting because this essentially requires companies like Amazon or eBay or other larger platforms that sell on behalf of third parties or other businesses to collect the sales tax and also remit it. So in a sense, having those new marketplace rules and requiring companies like Amazon to now collect tax really can help smaller businesses manage that burden if they do sell through a marketplace. But again, marketplace rules, which apply in the majority of states, will just push that sales tax collection and remitting responsibility onto the platform rather than onto the individual business. So, you may or may not trigger Nexus, but there's a lot of different, I would say, options and setup functionality in those platforms that it can help you manage your sales tax and make sure that it is collected either on your behalf or through their platform.
Yeah, and this is something that a lot of small businesses are taking advantage of, because from a business standpoint, I mean, it's a big deal. Amazon offers the platform to me, as a small business, and therefore I can, put my goods and and the products that I'm trying to sell on their platform. And it's Amazon, I mean, there's big opportunity there. And Amazon's one example. You named eBay, Etsy. There's a lot of other ones that are out there. But what from a sales tax perspective and from a nexus perspective, we call that marketplace nexus. That's the terminology that we use, where you're putting your stuff on a larger platform and that you're sort of utilizing that larger platform. And to your point, they do have very good tools to help you kind of manage your sales tax obligation there. But that's an important consideration because, you got the advantage of I'm selling my product on Amazon. Awesome, wider customer base, but it also means that we got to pay attention more to kind of sales tax and where those products are going.
Yeah, exactly.
Yeah. So, I mean, a lot of sort of interesting, ways that we are seeing here more recently that Nexus is starting to come into play in areas that it just wasn't there before. So the idea of Nexus, it's a moving target. One of the things that I think is also kind of interesting is we have seen some states that have gone to the administrative compliance, aspects of it. So even if, technically we don't, we may not have a sales tax nexus obligation. Sometimes we still have administrative obligations there as well. Colorado was one that got a lot of attention, but they were certainly not the only one that was doing that. Prior to Wayfair. But that's another one to just kind of keep in mind as well. I don't know if you've seen that with some of your clients, and they've maybe gotten, they've brought up concerns about that piece of it.
Yeah, great point. And for example, like with Colorado, they also have home rule jurisdictions for local sales tax and things like that. And you're referencing some of their notice and reporting requirements that prior to Wayfair may have been an option to actually reporting sales tax. So either report, significant detail regarding your customer base and notify them specifically by a certain period of their filing requirement, or you're liable or you need to file sales tax. So it's very interesting because it almost put too much of a burden back on taxpayers with those reporting requirements. So they kind of just threw their hands up and would rather really collect and file sales tax at that point. But again, there are so many different options out there with automated platforms to be able to do sales tax. So I think rather than really getting frustrated or thinking about how the burden's going to fall back on the company is really just understanding how to make it more efficient, how to make it cost effective, how to make sure, you're not putting your business at risk with being compliant or not. And we've talked a lot about sales tax and economic nexus. But one thing that I do want to bring up, it's a little bit related, but technically different, is the concept of gross receipts taxes. Mm-hmm. And these are based on sales into the state, but they're assessed at the entity level. So they're not something, for example, that you would pass on to your customer. In states like Washington, now Oregon, Ohio has had a gross receipts tax for a long time. These types of taxes are these sales threshold based. So you can easily trigger them without a lot of activity in that state. Just having one large customer, for example, in the state could trigger an obligation. And these jurisdictions are not shy about searching and trying to find delinquent taxpayers. So I would just caution that it's important to be aware of those states that have gross receipts taxes as well.
I think that's an excellent point because I can tell you that from starting a couple of businesses myself and running into some of those gross receipts tax, typically what you hear back from the client is they say, "I didn't make any money there. I mean, I didn't have net income there," and you say, "Yeah, it's not a net income tax. It's a gross receipts tax." And so I do think that's a great point as well. And states do seem to be kind of getting a little bit more aggressive in some of these areas. I mean, is that fair to say? What kind of trends do you see from the states in terms of kind of nexus and kind of where are they focusing their attention?
Great question. I definitely think that certain jurisdictions like Massachusetts or Washington have people that are really assigned to find, taxpayers that aren't reporting to their jurisdictions. So they're using different methods. I think using websites and search functions and things like that is an easy one. So, for example, e-commerce businesses, that's another risk. If other states are really just trying to cast a wider net and looking for taxpayers that may be selling into jurisdiction and just sending an inquiry notice. We, as a firm and, me as an advisor, I really try to educate our clients not only on, what these taxes are, but what your options are to remedy them. Because the first step really isn't to run out and register with a state because now you know that you owe tax. there are things that are called voluntary disclosure agreements or amnesty agreements. And occasionally these states have programs. And what these programs do is they limit the amount of back tax and or penalties that you may owe. So it's important to know that there are some programs out there that can kind of cap your liability. But if you come forward and you register and raise a red flag to the state before you file those applications, then you aren't eligible. So just making sure you have those conversations with your advisors to understand the implications.
And that's a great point as well. And what we're talking about there is the ability to basically come clean. So you realize that you have a problem, you have a client, either a client or you, if you're a CFO, or a controller, you realize that you have a problem with Nexus. Instead of going directly to the state, it might be a good idea to reach out to your tax practitioner, folks that, like Frances and the folks that are out there that specialize in the SALT area. I think that part's important as well, because the SALT area especially is a very specialized area, and there are firms out there that have specialists on staff that they just deal with state and local tax, because it is such a unique animal.
Yeah, no, I completely agree. And even if you have a general tax advisor, that's great, and they can provide you some advice and next steps. But if you really need to move forward with a specific program or make sure a calculation is correct and things like that, state and local tax professionals can be that extra help.
And the amnesty programs, by the way, too, I mean, a lot of them are, they're really trying to make it so that clients kind of get right. I mean, they're not trying to penalize the client for things that have already been done. In other words, stuff that's done in the past. The idea of these programs is to allow taxpayers to come forward and to not pay exorbitant amounts of back taxes, and allow them to just basically report and get right going forward. Is that a fair way to sum up the amnesty programs?
Yes, absolutely. From the taxpayer perspective, I think from a state perspective, they look at them as opportunities to also raise money from taxpayers that otherwise would not, pay the tax if they would just. They offer this program, and all of a sudden, a lot of taxpayers come forward. It helps from a state perspective with funding and a lot of different reasons. So I think those are really win-win programs.
I totally agree. So, I mean, we've been talking about trends. We've been talking about all of these different types of nexus. I mean, it's enough to, I think, sort of make the practitioner's head just kind of explode. What keeps you up at night, Frances? I mean, what are the things that you look at and you're like, my goodness, this is something that I got to tell my clients. This is something that me as a practitioner, I need to keep on my radar screen.
So it's interesting that you asked that. I really think the state world is ever changing. So there's always going to be a state law that changed, a conformity rule that changed, a new tax that is effective as of a certain date. I think for me, it's just like consciously understanding what the important changes are for my clients. And for example, right now, California just passed this week legislation that impacts my clients retroactively. So for me, this is a change that impacts tax year 2021. We're quickly getting into the 2021 extension and filing season. And, how do we assess this? How do we communicate to our clients? How do we make sure we don't, miss something specific? Because there aren't any instructions. There's just a law that was passed, and we may or may not be getting more guidance before, for example, March 15th or April 15th. So for me, that really does keep me up at night. But it also is a challenge. Like, it keeps me interested. It keeps me excited. It keeps me knowing that I provide value to my clients and my colleagues. So I love state and local tax. I'm a doctor of state and local taxation. So
There you go. I think that's about the most positive way to look at it, right? I mean, is that, we are in a world of change. I mean, and unfortunately, I think, from just kind of a wider scope, we've had multiple changes here, especially in the past, the past 2 years. I mean, past 2 years to be a tax practitioner has been pretty tough. It's been pretty tough. We've had major legislation go through, and I think to your point, some of it has been retroactive changes, which means that we really can't do much to sort of change what's happened. You can't really plan around sort of retroactive law changes, which I think can create a situation where the clients are going to be looking to us as the preparer, as the advisor, as the voice of reason in the chaos to guide them along and sort of guide them in the right direction.
Yeah, no, absolutely. And you're right. I mean, federal tax practitioners, just tax in general, with major reform and different incentives and programs that have happened that have impacted our filings or even our due dates, right? So we've had major changes, just reason for deadlines. So yeah, exactly. Just making sure we do the best that we can and with the information we have and serve our clients well.
So that my background is in startups. I've worked with startup entities, and even now, a lot of my clients, they're startup companies. I know that you get some of those as well. When companies are first getting started, I mean, do you have any sort of words of advice, any kind of rules of thumb that maybe they should be paying some attention to as they're getting going, as they're getting ramped up, getting ready to sell? What sort of things do you tell them when we're starting when things are starting to get serious, when we're actually starting to sell some products and really get our name out there?
Yeah, I think it's important to just understand tax in general. So don't put tax on the back burner and think, oh, we're not making money yet, like nothing tax related matters. Because, that may be a little bit true from an income tax perspective. Like you still need to make sure your filings are in order, et cetera. But from a sales tax, from a gross receipts, from a payroll tax perspective, these are all liabilities that will be with the company, whether you're making money or not. So just understanding what those other taxes are based on your headquarters or your home state, and then understanding what your growth plan is. For example, you learn about it now, maybe it's not an issue. Do you have a plan in 6 months and 12 months to review that? Because what I've found with some of our quote unquote startups is that we usually, when they start growing and making money, it's very quick. Right. So they, need to plan ahead a little bit. Otherwise, they're kind of caught in a situation where there may be exposure for certain things too.
And that's if you're doing it right. I mean, we start off, maybe there's nothing, but then usually with a lot of startups, there's kind of they have a big year because they got a good idea or they have a good product, and then all of a sudden these things matter. And I think we talked a little bit, you mentioned earlier on, just having systems and processes in place too, because that's a lot of this too, is that there's cost involved in sort of getting set up right so that we can actually track where sales are going, track who exactly our customers are and where they're located.
Yeah, no, exactly. And that is not my expertise, but absolutely technology is key to everything related to information reporting.
So I think probably, and some of you out there, I mean, especially if you're first getting started with a business and you're just kind of getting going, I do think that, I think the major message here is talk to the state and local tax practitioner early, especially if you are looking to do things across state lines, and don't be fooled too by geography. I know, some of our major cities. I mentioned Charlotte because that's one that I've lived in, a city that's near and dear to my heart. But like Charlotte is right next to the state line. There's a lot of other places that are like that. Some of the places in Northern Virginia. That they're right next to the state line. So don't assume that, hey, it's only a couple of miles up the road. If you're crossing over state lines, there's probably tax implications to doing that. So Francis, so when it comes to this issue of state and local taxes, I just think that there's a lot here. I mean, I think that that's probably fair to say. If folks would like to get a hold of you, what would be the best way for them to do that?
Absolutely. So the best way to do that is likely via email. And I'm happy to share that, and also LinkedIn. So it's very easy for you to add me on LinkedIn. I'm happy to connect. And my email at GHJ is fellington at ghjadvisors.com.
So, and folks, I can tell you too that as someone who is connected to Frances on LinkedIn, she puts some great stuff out there. So definitely a great way to connect with her. So Frances, thank you so much for being on Accountable. I think this is a great topic. I think this is something that that sometimes gets lost in all of the other things that we do, as CFOs, as controllers, but certainly an important topic nonetheless. So thank you so much for being on Accountable, and thanks for talking about this ever changing, ever moving topic.
Sounds great. Thanks, Dave, for having me.
Thanks for listening to Accountable. Be sure to subscribe for more interviews and insights from today's business leaders.
All tax preparation is performed by Peters Tax Preparation and Consulting, PC. CFO Capital Management and Cruise Financial Organization do not prepare tax returns. Peters Tax Preparation and Consulting, PC is not affiliated with CFO Capital Management and Cruise Financial Organization. CFO clients or prospective clients are never obligated to use Peters Tax Preparation and Consulting, PC as part of any financial planning or investment management services offered by CFO Capital Management and Cruise Financial Organization.